I'm Brian Yampolsky.
And I'm Joe Ashton.
And we are the co-owners of Orion Mortgage, and this is the Inside Track. And today's topic is...
It's the things that you do not want to do when you're attempting to buy a home or refinance.
That's right. Now, these are things that we've actually been telling our clients about for 20 years, but they still do it. So it's fundamental, but it's very, very important in order to ensure that you close your loan on time and that you close your loan, period. So.
Yeah. And some of them are very basic, but we thought we'd share them with you. I mean, we'll start with the most obvious thing. Don't quit your job.
Oh, that's a great idea. I had a client. I'm going to tell this story. This is going back maybe 10, 15 years ago. Client was employed, bought a house, came to me for a loan. We're in the middle of the process of getting the loan approved and closed. And the lender called to do a verbal verification to make sure the guy was still employed. And guess what?
I quit my job.
He quit his job. And so I called him and I said, hey, we tried to verify that you still had your job, and they said you don't work there anymore. And he said, yeah, that's true.
Is that going to be a problem, he said?
He said, yeah,
it's a problem.
I decided I was buying a house, and so I'm going to actually go back to school. So he quit his job. That is a problem.
Yeah. So.
And in case you weren't aware, the lender is going to verbally verify your employment at the very end of the process.
Yeah.
So like the day before closing.
And that's an obvious one, don't quit your job, but it's also very important to share with your lender if you're going to make a job change at any time, because that could affect it too. So that's the number one, and of course that's it seems obvious, but it's happened.
That's right. That's number one. Number two is probably one of the most common ones, which is try to avoid large deposits in your bank account.
Okay, now there are some standard large deposits, like when you get your payroll or you get your tax return. Those are obvious, and that's what they're looking for. That's the good kind of deposit. Any other kind of deposit that doesn't come from a normal source needs to be documented and explained.
Right.
The reason for it is?
The reason for it is the lender needs to know that the money that's in your bank account is coming from an acceptable source.
And it's your money.
Right. So it hopefully is your money, but you can also get gift money in certain circumstances. But what you can't have is you can't borrow money against your credit card. You can't just, sell drugs and get a whole boatload of money.
Right.
There are illegal sources that you can't use money from. So basically, no large deposits in your bank account that cannot be explained or documented.
And here's another good one. No new credit.
Ah, yes.
No new credit is important because new credit when you get a new credit inquiry, it can lower your score. If you get new debt, it's going to increase your debt ratio. It seems fairly obvious. The biggest mistake you see is somebody getting really excited and they're about to close on their home and they see in the newspaper, this weekend only, new refrigerators. You use our credit card, we'll give you 10% off. So they get a new credit card, they jack it up, they have new debt, credit score goes down, they had an approval, they're not approved anymore.
Right.
So wait till you buy.
Now, just again, another side note. Because Joe just told you, that when you get new credit, it lowers your FICO score, your credit score. One of the reasons why that happens is because when Fair Isaac, which is the FICO scoring company that created the FICO score, they determined, whether you want to believe it or not, that the behavior of people who are about to go into bankruptcy usually includes the acquisition of new credit cards.
Mm-hmm.
So when you are getting a new credit card, that throws out red flags all over the place, and it's a bad sign for your credit score. One of the next most common don'ts is don't run up the credit card balances on your existing credit cards.
Yeah, that's another one. Just because as your credit balance approaches your limit, your score goes lower and lower, even if you make the payments all on time. So the rule of thumb is you want to keep it under 30% of your limit to get the best score. When you start going above that, it hurts you slightly. When you get above 50%, it starts hurting more. So try to keep your credit card balances low.
I got an example of that. Friends of mine applied for a loan, and right in the middle of the process, they paid for their kids' camp, and I think it was a couple grand. And that ran their credit card balance up above what's considered the limit where it starts to affect their FICO score, and it dropped their score to the extent where the rate that they were trying to get was no longer available. So it's definitely something you want to avoid. What's the next one?
The last one is if you can avoid it at all costs, if you can, try not to co-sign for anybody. We have so many people, really well-intentioned people, co-signing for their kids on a car to help them establish credit, or their grandkids. And the conception, or everybody's impression, is that it's not going to affect your credit. But it does affect your credit. And not only does it affect your credit, you're responsible for that credit card or that car loan as if it were your own.
That's
and
right.
it goes to it's added to your debt. And the worst possible thing that you've done there is you've given somebody else, whether it's a son or a grandson or a daughter, control of your credit score. If they miss a payment, you're affected.
That's right, and a lot of people, when they've co-signed for a son or daughter, and we bring it up and we see it on the credit report, we'll say, oh, it looks like you've got a debt here, and they say, oh no, that's my son's car loan, I just co-signed for him. Well, when you co-sign, you're just as responsible and just as liable as the son or daughter, so please try to avoid co-signing.
These things sound obvious when we explain them to you, but we see it all the time, and so we spend a lot of time sharing this with our clients, and we thought we'd kind of put it out there so people could maybe see it proactively before they start that process of looking for a home, and also for the realtors that we're working with. It's good information to have for your clients.
That's right. So please share this with everybody you know that you think is either going to buy a new house for the first time, or even if they've bought many houses, it's still a good refresher. Call us if you have any questions. We've got a number on the screen right now, and also you can email us at the email address on the screen. That's it. Have a great
Thanks.
day.